give it to your accountant. Your accountant's not going to know what to do with it. That's something that you could. I have a resource for you guys on that. And then I'll wrap up with the R&D stuff, which is an exclusive offer for your guys, for the CEO Network guys, and for the OSS guys. Mm-hmm. So I wanted to put that out there.
Make some money, man.
I want
CastleClub as well.
Yeah. So I started a new company for the R&D because there's been kind of an expansion in this. That was, again, under the one big, beautiful bill. And a lot of businesses qualify for this. For instance, like restaurants are a good target for it. If you change some menu items, if you change your cooking process, if you put a POS system, or if you have any type of, website with AI integration and stuff like that, a lot of small restaurants in your neighborhood qualify for this stuff. And there's substantial amounts of tax credits that they qualify for. So we have a company that I set up for it. And I'm looking for 20 motivated guys that we could bring on, train them.
Cost them nothing. They get free training and they can make some money.
I'm pretty good at identifying some pretty good talent. So I know your guys are, these guys are wanting to level up. So I want to invite them to come in. I want to start the first class with 20 guys. And I'm going to train them all personally myself with a couple of guys. I have my partners. We're going to provide all the tools that they need necessary, all the lists, all the flyers, all the education that they need to talk to clients in an articulate way to get them qualified. And there's nothing, this is something you go out and we have the whole system set up where you go in and you follow it step by step and you qualify a client, because this stuff has to be audit proof. So we're doing it from a CPA standpoint. We're not trying to do this from, we're not trying to just make commissions. It's got to be, we have to be able to, have a package ready, if the IRS should come back where we can substantiate everything and have it hold.
Make it official.
Yeah.
All right.
So it's a good way for these guys to make money. So we'll wrap up with that and talk a little bit about that.
No, it's a good opportunity. Costs them nothing, and they get free training on that topic. All right. So let's go through it. So the first topic, what was the first thing you wanted to?
Big beautiful bill.
And guys, get your questions in now, and then, like I said, we're gonna open up phone lines at the end of the show. But we're gonna let Steve kind of run through his. So
I'll go for the first one because everybody in here. A lot of guys I'm always hearing that they want to talk about real estate. Again, I have a real estate book. I think it's like $17 or whatever, and it really walks you through to prepare you to bring all your stuff to your accountant at the end of the year to make sure you're doing things right. So go in there, download it, look at it. It's a quick read. But the bonus depreciation right now.
Can you tell them what depreciation is, and then
absolutely,
and then what bonus depreciation is, because they might not understand.
So basically, when you buy a house, the house is typically most accountants, like, they'll allocate a little bit for land. Let's say that you buy a $500,000 house. You have to depreciate it over time. So that means the house gets expensed not all in 1 year. You have to expense it over 27 and a half years.
If you have a 30-year mortgage, right?
That has nothing to do with the mortgage.
Oh, so okay.
Has nothing to do with the mortgage, no. So I buy a house. Let's say I buy a house cash, and I'm going to rent it out. I can rent it, it becomes a business asset, right? So it's an income producing asset. So I can depreciate it. So I want to expense the $500,000, but I can't expense it all in 1 year. You have
to be earning it. You can't depreciate if you're living in it only.
Well, let's say I buy a house just to rent it.
Okay.
Okay. So it becomes, because you don't depreciate your primary residence.
That's
right?
what I meant. Yeah.
So it's an investment. So I want to depreciate over time. So the government's IRS says, hey, you could depreciate it over 27 and a half years. Oh, and by the way, you can't depreciate the land. So I have to allocate $100,000 towards the land. Now I have $400,000 of costs that I have to depreciate over 27 and a half years. So a lot of guys do a cost segregation study. So they think, okay, I have to hire a firm. I have to get it professionally done. Some of these on the low end cost like $5,000 to get done. Some on the higher end maybe are 10 to 15 grand. So in my opinion, if you buy a $500,000 house, you don't really need to pay an engineering firm to do it. We did it to your properties. Your properties are all under a certain amount. You can get a good CPA that kind of knows what he's doing, and you can kind of estimate the cost of, how much the carpeting is, how much are the cabinets, so we could do a cost segregation, and you can segregate pieces of that house. So instead of just putting it all $400,000 over 27 and a half, we could take out 5-year assets. So that could be the carpets, that could be some of the floating floors, that could be the draperies, that could be the cabinets, things that are not structurally to the house.
And go ahead. Do you want to say something else?
So I'll put that in 5 years.
Gotcha.
So let's say I pull out 50 grand of those 5-year assets. Now I got 350. 50, I can deduct 100% of that under the bonus depreciation new rule. And then I can go to my 7-year assets. So that could be like the driveway, the fence. That could be other things on the outside of the home that you could depreciate quicker. You can accelerate those things, and you could depreciate those 100% of it in year 1.
So, and real quick, because I'll just so the audience really understands what you're saying here. So, guys, when you buy a house, right? Basically, what depreciation is like you're writing off the wear and tear that your house is going to experience over 27 and a half years, right? And the reason why he was saying like we take a $500,000 house, the reason why it goes to 400 is because the government automatically assumes that 20% is going to be the land.
Correct.
So the other 80% is going to be the actual house. That's what you could depreciate over the 27 and a half years. So you got $500,000, you know, well, I'll even go easier math. $100,000 house, right?
Yeah.
20% is automatically gone. So now you got that 80K that you can work with.
Correct.
Now you're going to basically go 27 and a half years over 80K. What is that per year?
Like, let's say $1,600.
$1,600 a year that you're going to save in taxes.
Right.
If you take that $100,000 house, 80% of it, that's the structure. 20% of the land, you can't depreciate land, guys. That's why buying land alone kind of sucks for tax benefits. So that 80% on the structure, then you depreciate that over 27 and a half years. That's $1,600 a year. And then on top of depreciation, you get another bite at the apple to lower your taxes, which is cost segregation. Which, think of cost segregation as like the brother of depreciation that's more aggressive, right?
Correct.
So cost segregation is another way to kind of limit your tax liability. That tends to be on a faster scale. So versus 27 and a half years, now it's 5 to 10 years, but it's on stuff that isn't structural. Like you said before, things on the interior of the house, right?
Correct.
Which would be, give some examples.
So
like,
you know, carpet and padding, cabinets that are like you can screw them out and remove them.
Kitchen fixes, right? Bathroom
light fixtures.
Yeah,
correct. Yeah, vanities, things of that nature. You could depreciate them quicker. So rather than getting like roughly a $2,000 deduction for depreciation, you can get maybe a $20,000 deduction, which is a huge. Then you offset that against the rental income.
So let me ask this then, just so that they fully have it. So let's say we take it for easy math purposes. Even though you're never going to find a $100,000 house, right?
Yeah.
Now you take 20% remove, we got 80,000. So 27 and a half years, that's about 1,600 a year. Then we get a second bite at the apple with the cost segregation. Let's say we spend, make math easy, 10,000 on the interior of the house on the non-structural stuff, kitchen cabinets, whatever it may be, just for easy math. That 10K that we spent, can we deduct all of it, or
yes.
can we once, right?
That's what so now you can do 100% of it. So even that is quicker because that's a 5-year asset. So we should take 20% of it, right? Mm-hmm. But now, so under the new bill, you say, no, you could take 100% of it in that 1 year.
Under Trump, big, beautiful bill.
Correct.
So under other presidents, guys, it would have been that 10K you spent, you would have had to wait 5 years. So let's do the math again. $100,000 house. 20K is gone because of land. The government basically gives you 80K to use to depreciate. $1,600 per year. So you take that off. Then let's say you spend $10,000 fixing stuff inside that's not structural, right? The cabinets and everything else you mentioned. It's up to you. You could take that 10K and deduct it once for the year, limit your tax liability with the $1,600 plus the extra 10K, or you could do it over 5 years.
Correct.
And Trump is the one that basically put it in place where you could take that cost segregation and take all the benefits from it that first year if you want.
Correct.
Because other presidents would be like, okay, you could still, I don't want to use the word depreciate. You can still get the benefit, but it would be over 5 years versus 27 and a half years. So you basically cut more taxes in a shorter period of time. But Trump allowed it where, you know what? We could give you guys one up front where you take that full 10K off your taxes.
Correct.
If they want.
Yep. That's perfect way to explain it.
Yeah.
Better than I could.
Yeah. Give me ones if that makes sense for you guys. Because a lot of people get confused with the difference between depreciation and cost segregation. Even me, like I even forget some of the stuff. Like I was in my head, like, wait, can you get it? Can you still depreciate if if it's a 30-year fix? And it's like, no, even you buy cash. Yeah. Which now I'm like, yeah, you're right. And then,
but is it better to wait the years or do it right away at the very beginning?
It depends, because you could have other rental properties that are fully depreciated or just producing, and they're cash flowing a lot better.
Yeah,
and you want more aggressive depreciation to offset against those others. Typically when you have multiple properties, it comes into play. But the main driving thing here, I want to make sure that you understand is that the with the bonus depreciation is or the cost segregation.
And that's only exclusive to Trump. Has any other president allowed that? Because I remember Trump.
Well,
won,
it
he
came
allowed
in.
it.
Yeah, it came in 2017, so that was under Trump. So this is all the renewal